Hello and welcome to this video. I'm Milind Date and I'm an expert tutor for the AFM examination. In this topic explainer video for AFM, I'm going to cover some important aspects about the concept of adjusted present value and provide you with tips on how to answer the tasks that require you to estimate the adjusted present value, interpret the result thereof, and then advise the organization based on the details given to you in this scenario. Please remember, this is not a detailed teaching video, but only giving you some of the tips. So before we actually start talking about the adjusted present value as a concept, let us look at how it's included in the AFM syllabus. Well, it is included in the section B of the AFM syllabus, that is devoted for advanced investment appraisal as a decision-making area. Please be careful in understanding the learning objective over here. It says you're just not supposed to make calculations, but apply the technique to appraisal of investment decisions. And it entails significant alterations, as the syllabus words, in the financial structure of the organization, including fiscal and transaction cost implications thereof. You must learn to revise the concepts that are directly involved in estimation of the adjusted present value, namely the discounted cash flow technique, the weighted average cost of capital calculations, the concepts of asset beta and equity beta, process of ungearing beta, the proposition, Modigliani and Miller propositions for ungeared cost of equity calculations. Please remember, this area is quite often tested in the AFM examination, and from that angle, it's really very, very important. Of course, there's no way in which I'm trying to spot questions for you, but remember, very good learning of this could go a long way in you passing the AFM examination. You will definitely need rigorous practice on this topic. And here, carried forward knowledge from your financial management paper will definitely help you. Concept of beta, the process of ungearing the beta, the capital asset pricing model, revise them in depth, no doubt. Of course, most of the formulae will be available to you in the formula sheet, even at the AFM examination in the CBE environment. And for this topic, which is on the new technique of adjusted present value for you, you'll find the learning material in the ACCA Study Hub, subsection 1 of the chapter number 6. Please don't forget learning from that. A very, very useful resource directly coming to you from ACCA. You can access the ACCA Study Hub, of course, from the My ACCA account. So the way the adjusted present value technique works is definitely a part of your new learning, bringing forward, of course, your knowledge from the financial management paper. But what this technique entails, remember, the APV technique has emerged because NPV has its limitations. The net present value technique definitely, ignores financing cash flows. If you remember those calculations of net present value, we take only investing cash flows related to initial investment, working capital, the net realizable value at the end of project period, realization of working capital invested, and then the operating flows like revenue, cost, etc., taxation, etc. But it does ignore financing cash flows when you evaluate the investment decision. But APV technique actually is an improvement over NPV in this sense. It separates the investing and operating cash flows from financing cash flows and tries to assess the effect of both the cash flows on the value generated by the project. So a project may provide additional value if it is funded by making a sort of a choice which is very relevant and suitable for the given scenario. Generally, what we have learned at the financial management level is that if NPV is negative, we tend to, reject the project. But a project can generate additional value if it is, for example, funded through debt. In short, the technique helps us determine the value of a geared project, a project that is funded from debt. That's a geared project. And this actually, again, is derived logically from the Modigliani-Miller proposition that value of a geared firm is equal to value of an ungeared firm plus the present value of tax shields. Somewhere very close to this assertion, APV technique helps us in appraising the project. So let's quickly look at what calculations are involved and what are you supposed to learn while learning the concept of APV. It involves calculating the value, first of all, as if the new project is going to be funded entirely out of equity, no debt, only out of equity. And then calculate the present value of the financing side effects that flow to the entity due to use of debt. Use of debt specifically brings to us the tax shields. Now, the value which we determine by assuming that the project will be entirely funded from equity and then calculate the net present value, that NPV is termed as base case NPV, as if the project is funded by equity. And the side effects will generally include, as I said, one of them is tax shield on the interest on debt. When you issue new capital in terms of debt to fund a new project, there are issue costs of raising the funds. So that's another financing type cash flow. Many times, if the new project that is being contemplated is of national importance to a country in which an entity operates, the entity may get, government subsidies. So getting government subsidies or getting softer loans may act as additional benefit because you make a choice of new capital to be raised from those resources. So two things the calculations will require. One, calculation of a base case NPV. Second, the present value of the financing side effects. So the base case NPV, as I said, is calculated with respect to consideration of initial investment, working capital investment, realizable value of the project, and the operating cash flows, as I said earlier, like revenues, costs, and taxes. When you determine the cash flows, use your carried forward knowledge from the AFM paper, but discount them. Now, here is a catch. You normally discount for calculating NPV, you normally discount taking the weighted average cost of capital or a project specific cost of capital. Here, you discount it using ungeared cost of equity. And why we take ungeared cost? Because the assumption is we are going to fund the entire project out of equity only, no debt, so no gearing, and therefore ungeared cost of equity. Now, ungeared cost of equity, you can calculate in two ways. You will need to learn the ways in which to calculate it. And the study hub resource very, very clearly explains it to you. So you can either use the process of ungearing the beta, taking, of course, the proxy company information, and then using that ungeared beta in capital asset pricing model formula to calculate ungeared cost of equity. If relevant information is not available to you in the exhibits, you can make use of the Modigliani-Miller proposition, for which the formula is available to you in the formula sheet. And again, it is based on the basic idea of proposition that value of a geared firm equals value of ungeared firm plus the tax effects. So using them, you make the estimate of ungeared cost of equity, use that as a discount factor to find out the present value of investing and operating cash flows, finally to get your base case net present value. So this is a logic that you need to learn. Please remember, many students I have found, learn mechanically. And that's not going to help you, because the way in which the data may be provided in exhibits is not a standard way of information. It's for you to, read the exhibits very carefully and get the information interpreted the way it is required to. So that's very, very important for you. And then when considering the present value of financing side effects, what you will need to do is to consider cash flows that are related to, for example, the tax shield on using debt, benefit of subsidized loans, and the issue costs. Mainly these three, cash flows occur so far as financing side effects is concerned. Sometimes you also could get a cash flow that is related to increase in the debt raising capacity of the firm. I'll talk about that a bit later. Take these financing cash flows and discount them. Now, see, that's the difference between the basic NPV and the APV method. In NPV, we use only one discount rate. In APV, we use ungeared cost of equity as a discount rate for base case NPV and the pre-tax cost of debt or a risk-free rate for calculating the present value of financing side effects. Now, experts do differ whether they should go ahead and use pre-tax cost of debt or risk-free rate. The AFM examiner has made it very clear you could use any of the two, but state your assumption very clearly. So these two calculations are of paramount importance for you to learn very carefully. Of course, just learning is not going to be sufficient for you. You need to practice a lot of sums from the past exam questions. Now, let's see how the process of ungearing. I'm not going to, of course, teach you this, but this is just, revising your knowledge from the financial management paper. The estimation of asset beta. It is given by, multiplying your equity beta with the value of equity to the total post-tax, value of equity and debt. This information is available to you from a proxy company viewpoint. You have to take that, calculate the cost of ungeared beta, and input that in the CAPM formula as such. Second way of doing this calculation is directly using the proposition. And that says cost of a geared equity, KE, is given by cost of ungeared equity plus difference between the cost of ungeared equity and cost of debt multiplied by the proportion of debt to equity post-tax, of course. That's why 1 minus T. If you want to make use of this formula, there's a tip for you. It's many times the students ignore this and ultimately get calculations wrongly. KD in this formula has to be taken as pre-tax rate. Now, why? The reason this KD here has to be pre-tax. The reason is you're already multiplying this by 1 minus T. So if you take here the post-tax and again multiply the bracket with 1 minus T, you will be double counting taxation. So this tip, please remember very, very carefully. Okay. Now, while understanding the normal operating and investing cash flows is easier for many of the students because they have done so well in the financial management paper by plotting cash flows successfully. It's the side effect calculations that are a bit tricky for you. And that's why I'm going to tell you about these calculations by way of certain tips. If you put it in this way, I strongly recommend you definitely will be able to make the calculations correctly in the examination. So let's first handle the cash flow that is related to issue costs. When you are contemplating investing into new project with new funding raised, either it could be full debt or it could be a combination of debt and equity. So the funds that will be available to you will be definitely net of issue costs. And therefore, when you're talking about the issue cost related cash outflow, you need to gross it up. And that's a very, very important step that generally students miss out on and unnecessarily lose marks. Now, I've given a small example here that if the funds required to be invested are 4 million and the issue cost is 4%, the gross funds that you will have to raise would be, $4.17 million. So that post the issue cost, net 4 million will be available. Because these are, and this is second tip, very, very important. Don't miss out on this. Because issue costs are spent upfront, you don't need to calculate the present value of issue costs. Many students apply discount factor even here and go wrong. Based on the jurisdiction, these issue costs either may be tax allowable or not allowable. So somewhere in the exhibits, look for this information. That's why I said the information may be available to you in a scattered manner. So you have to use all the sufficient care to make sure that you read it properly. And that too, if they are tax allowable, whether the tax is payable in the same year in which it is incurred, or it's in arrears, 1 year in arrears, 2 years in arrears, etc. If it is in arrears, tax amount related cash flows, you have to calculate the present value. So these are finer points which you should keep in mind when doing the calculation of financing side effects. I spoke to you about the debt capacity, spare debt capacity. If you're doing a project that's of certain importance for the fund providers, or it's likely to give very, very high level of values, which will increase your equity. So your gearing will improve, and that can provide you with some spare debt capacity newly. Although that spare debt you could use in other projects. Please remember, that's because of this project that you are getting that extra capacity. So you should attribute it to the value generated by this project. And the present value of this spare capacity should be calculated using the formula trick that I have given. It's logical. Take the increased debt capacity value, multiplied by the interest rate, the tax rate, because you're going to get the tax advantage on that, and the annuity factor based on which the period for which you are raising this particular debt or the life of the project. So second financing side effect. The third financing side effect could be related to subsidized loans. Two possible effects can arise out of that. One is the tax shield on the loan amount itself. So if you're getting a soft loan, take that amount of soft loan multiplied by the soft loan related interest rate, tax rate, of course, and the annuity factor. And as I said, this you could discount either by taking the risk-free rate of return or pre-tax KD, cost of debt. Write your assumption, whatever you are doing. And second benefit is related to benefit because you save in the interest cost because of subsidized effect. So you take the amount of soft loan multiplied by the difference in the interest rate. Normal loan may be available at 8%, you get here at 6%. So 2% is the difference in the rate multiplied by annuity factor, and take this cash flow post-tax. Because on the saving, you need to reflect the tax amount that you have to deduct. Net of tax benefit will be available. Again, discount rate could be risk-free rate or the pre-tax. Learn these very well. Refer to these calculations while you are actually solving past exam questions, and do a rigorous practice on this. Very, very rigorous practice will be recommended. You need to apply this technique of APV. Many times, examiner will not directly tell you to calculate it, but the exhibit may provide you with some information where they indicate a substantial change would occur in the capital structure post the new project. Or they may tell you financing will be from debt, so financing side effects will be there. So some hints the examiner will give you instead of directly telling you that you should calculate APV. Examiner must just say, okay, evaluate the financial suitability of the project, financial feasibility of the project. Now, generally you would try and calculate the NPV, but if such hints are given, you need to tell the examiner, hey, because of these reasons, I'm using the APV technique and not the general NPV technique. So, two calculations which you make. Base case NPV might be negative, But if you combine the total value generated with the value of financial side effects, it may turn to be positive, and that may mean that you should go ahead and accept the proposal. And therefore, interpreting the base case NPV and interpreting the present value of side effects is very, very crucial for you. Very crucial. Of course, I mean, this technique also suffers from criticism. Experts say that it ignores the impact that a change in the capital structure is likely to create on the value of the firm if you take its existing operations. And this could be tested in a very small way in terms of a discussion question, testing your skepticism skills once more. So beware of this critic. It's mentioned in the ACCA study hub, so please learn it very well. I'm showing some, useful calculations for calculation of ungeared cost of equity. And this is the information that is available to us. Alpha is a well-diversified risk-seeking company. Its gearing is given, equity beta is given, and a pre-tax cost of debt is given. A proxy firm has a certain different gearing ratio, different cost of equity, and their corporate debt is risk-free. Now, tax rate is given, and the risk-free rate is also provided with of course the market risk premium. Now, what you need to do, I'm going to show you both ways in which you can calculate the cost of ungeared equity. First, let us use the equation, where cost of ungeared will be determined by considering the proxy company for which cost of equity, geared equity, is directly given to us. So if you input the numbers in the equation, you will be able to solve it and get the cost of equity 16%. Another way in which you can calculate is by process of ungearing the beta of proxy and using it in CAPM formula. Your answer should not be different. But there is one catch in this, which I'll definitely tell you. And the catch is, when you make use of this formula, ungeared beta should be directly used in CAPM. Don't re-gear it. Students generally make a mistake because they are so well versed with, okay, first ungear, then re-gear. No, you want ungeared cost of equity, and therefore you need to need not re-gear it, but directly apply CAPM. You see the answers by both are same, which is of course the 16% cost of ungeared equity. So depending on your comfort level, you could make use of any of the approaches in calculating ungeared cost of equity. Well, resources, ACCA Study Hub should be your primary resource. Apart from that, of course, once you learn the concepts, practice rigorously using the ACCA practice platform, where a lot of past exam questions are available to you. But when you look at the past performances of the students, do not ignore examiners' observations on how the students approach the answers. And therefore, so far as this concept is concerned, I'm giving some, comments of the examiner. Look at this comment, which the examiner has made. Especially, some candidates incorrectly calculating geared cost of equity rather than ungeared cost of equity. A conceptual error. We can't make this error. While others calculated weighted average cost of capital, that is also wrong. Candidates making these errors need to understand the rationale behind discount rate used. in base case NP. The rationale, that's the conceptual understanding. Look at another comment. On the whole, candidates who did not well demonstrated either a lack of understanding. See, lack of understanding means they have not prepared themselves in the rationale behind discount rate for base case NPV, or a lack of question practice. Both are very, very crucial. So isolate the effect of one business activity in asset beta of a diversified company. So these are really very clear observations made by the examiner. Never forget them. Never ignore them for your preparation. So what have we discussed in this video will help you in understanding why APV can be most potent technique to use in appraising an investment project, and it could either be tested in a 50-mark question or in section A, or a 25-marker in section B. So that's it from me. I wish you all the very best for learning, and at the same time, I thank you very much for watching this video.